When the dollar collapses, drug prices will spike by 30% to 50%. If you rely on prescription medications, your monthly costs could effectively double. Housing when interest rates surge to 8% to 10% due to the loss of foreign buyers for U.S. Treasuries, mortgage costs will explode. A $400,000 mortgage at 3% currently costs $1,186 per month. At 10%, that same mortgage would cost a staggering $3,509 per month. Your housing costs would more than double. Let's tally these figures. An additional $3,520 for petrol, $2,100 for food, $1,500 for consumer goods, and $1,000 for healthcare. If you are also in the market for a house, consider an additional $800 plus per month on your mortgage. This cumulatively amounts to an increase of $7,720 per year in direct costs, plus a further $21,600 annually if you have a median mortgage. For a median American household income of $75,000, absorbing an annual cost increase ranging from $7,000 to $29,000 is simply catastrophic. You will be unable to maintain your current lifestyle. You will drastically reduce your driving. You will resort to cheaper foodstuffs. You will delay essential purchases. You will find yourself unable to afford to buy a house, and you may even face losing the house you currently own. This is the stark, practical reality of what the end of the petrodollar truly means. Your actual life becoming 40% more expensive while your income remains stagnant. So, what tangible actions can you take? How do you realistically protect yourself when the very foundation of American economic power has visibly disintegrated? Own hard assets that intrinsically retain value, irrespective of currency fluctuations. This primarily means gold and silver. When the dollar inevitably collapses, gold consistently maintains its purchasing power, as it always has throughout history. It is no mere coincidence that central banks globally are acquiring gold at unprecedented rates right now. They too recognize the inevitable trajectory. It is a calculated pattern derived directly from the historical collapse of the British pound, meticulously adjusted for the accelerated speed and interconnectedness of modern financial markets. And critically, we are already firmly entrenched in Stage 1, rapidly approaching Stage 2. Now, allow me to illustrate precisely how this impending crisis will impact specific facets of your daily life. Because understanding the macroeconomic shifts is ultimately meaningless unless one grasps the profound micro-level repercussions. Petrol prices today, petrol averages around $3.50 per gallon in the U.S. When the dollar loses 40% of its value and oil is priced in yuan or a diverse basket of currencies, petrol will foreseeably cost between $8 and $12 per gallon by 2028 to 2029. If you drive 12,000 miles per year at 25 miles per gallon, you consume 480 gallons. At $3.50, your annual fuel cost is $1,280. At $10 per gallon, that cost explodes to $4,800. That represents an additional $3,520 per year solely for petrol. Food prices. America imports approximately 15% of its food supply and heavily relies on imported fuel and fertilizers for its domestic agricultural sector. When the dollar collapses, imported food will become 40% more expensive. Domestic food will also see a 20% to 30% price hike due to the elevated costs of fuel and other essential inputs. The average American family currently spends around $7,000 per year on groceries. A 30% increase would mean an additional $2,100 per year. Consumer goods. Electronics, clothing, furniture, and appliances, almost all of which are manufactured overseas, will be severely affected. When the dollar significantly depreciates, these items will become 40% to 50% more expensive. A $1,000 laptop could suddenly cost $1,400 to $1,500. A $30,000 car could become $42,000 to $45,000. Healthcare. Many vital pharmaceuticals and essential medical devices are imported. The dollar's share of oil transactions will drop below 70%. Foreign central banks will actively begin to divest from U.S. treasuries. Consequently, U.S. interest rates will be forced higher to attract necessary buyers for government debt. Inflation will spike dramatically, reaching between 8% and 12%. Petrol prices will escalate to $7 to $10 per gallon. Grocery prices will rise by a staggering 30% to 40%. This marks stage 2, the crisis becoming unmistakably visible. Asterisk 2027 to 2029. The breaking point: the dollar's share of global oil transactions will plummet below 60%. The US dollar will lose between 30% and 40% of its value against other major global currencies. Import prices will explode upwards. Inflation will hit an alarming 15% to 20%. Interest rates will spike to an unprecedented 8% to 10%. The housing market will crash catastrophically, as the vast majority of people will be unable to afford mortgages at 10%. The stock market will experience a severe crash, potentially losing 40% to 50% of its value. Unemployment will surge to between 12% and 15%. The government will be forced to confront an impossible choice: hyperinflation or sovereign default. This defines stage 3, the full-blown crisis. Asterisk 2029 to 2032. The new system: the dollar will no longer hold its position as the primary global reserve currency. The Chinese yuan will firmly dominate Asian trade. The euro will solidify its dominance in European trade. Gold will re-emerge as the neutral, trusted reserve asset for central banks worldwide. America's standard of living will fall by 40% from its previous peak. The global empire will contract severely. Military spending will be slashed by 50%. Foreign bases will close en masse. America's global influence will effectively cease. This is stage 4, the post-dollar world. This timeline is not mere speculation. There are only 3 stark options. Firstly, cut spending elsewhere by $1.5 trillion. This would necessitate drastic cuts across virtually all sectors: Social Security, Medicare, defense, everything, by as much as 30%. Politically, this option is nigh on impossible. Secondly, raise taxes by $1.5 trillion. This would translate to a crippling 25% tax increase on every American, a move that would be politically suicidal. Thirdly, print more money to simply cover the widening gap. This path, however, would only exacerbate existing inflation, trigger further dollar devaluation, and ultimately accelerate the crisis into an uncontrollable spiral. Every single one of these options inescapably leads to a significantly lower standard of living for Americans. There is simply no viable escape route once the petrodollar is gone, and it is already gone. The June 2024 expiration marked its official demise. Now, we are merely observing the decomposition of the body, and the timeline for this process is far faster than anyone in power is willing to admit. Based on current trends and established historical patterns, here is a plausible timeline for the unfolding dollar collapse. Asterisk 2024 to 2025, the warning phase, where we are now. The petrodollar agreement expired in June 2024. Multi-currency oil sales are accelerating. The dollar's share of global oil transactions is projected to fall from 95% to approximately 80%. Foreign central banks will begin a slow, deliberate reduction of their dollar reserves. Inflation will remain stubbornly elevated, likely between 4% and 6%, despite concerted efforts by the Federal Reserve to temper it. This constitutes stage 1, the initial warning phase. Asterisk 2025 to 2027. The acceleration phase: China and Saudi Arabia will formalize long-term, yuan-denominated oil contracts. Other OPEC members will progressively follow suit. Russia, Venezuela, and Iran will continue their concerted shift away from dollar pricing for oil. If just 30% of that expenditure is dedicated to imported goods or goods that rely heavily on imported components, that amounts to $21,600. A 40% increase on these imported items would therefore mean an additional $8,640 per year in costs. Your cost of living would increase by $8,640 annually, while your salary remains unchanged. This effectively makes you $8,640 poorer in real terms. This is not a mere hypothetical scenario. This is precisely what transpired with the British pound when it lost its reserve currency status between 1950 and 1970. the pound depreciated by a staggering 60% against other major currencies. British imports consequently became vastly more expensive. As a direct result, the British standard of living experienced a marked decline relative to other Western nations, a trend that persisted for an entire generation. And, chillingly, the very same trajectory is now set to unfold for America. But there is a third, even more devastating effect: the loss of borrowing privilege. Recall that the petrodollar system allowed the U.S. to borrow at artificially low interest rates because foreign countries desperately needed a safe haven to park their accumulating dollar holdings. However, as nations progressively reduce their dollar holdings, they will simultaneously cease to purchase U.S. Treasury bonds. And when demand for these essential government securities diminishes, interest rates must necessarily rise to entice new buyers. Currently, the U.S. government pays approximately $1 trillion per year in interest on its colossal $36 trillion national debt, equating to an average interest rate of about 2. But if the collapse of the petrodollar forces these rates upwards to 6% or even 8% to attract buyers, the annual interest payment on $36 trillion would balloon to between $2 trillion and $9 trillion per year. That represents an additional $2 trillion to $9 trillion in annual interest payments alone. So, where would this enormous sum of money originate? When there is a widespread selling trend and a corresponding lack of buying interest, the value of the dollar will inevitably decline. The dollar will weaken considerably against the euro, the yuan, the yen, and virtually every other major currency. And critically, when the dollar weakens, imports become commensurately more expensive. Here's how this mechanism operates in a practical sense. Today, the exchange rate might stand at $1 to 7 Chinese yuan. An iPhone manufactured in China might cost 7,000 yuan to produce. At the current exchange rate, that translates to approximately $1,000. Consequently, you pay $1,000 for the iPhone. However, if the dollar were to lose 40% of its value due to a precipitous lack of demand, the new exchange rate would become $1 to 2 yuan. That same iPhone still costs 7,000 yuan to manufacture. But now, to acquire it, you would require $1,667. Crucially, the iPhone itself didn't become more expensive in China. It was the dollar that became significantly weaker. And you, the American consumer, are compelled to bear that substantial difference in cost. Apply this chilling reality to virtually everything America imports: electronics from China, automobiles from Japan and Germany, clothing from Bangladesh and Vietnam, coffee from Colombia, bananas from Ecuador, oil from Saudi Arabia, and vital prescription drugs from India. When the dollar sheds 40% of its value, all these commodities and manufactured goods will become 40% more expensive in dollar terms, almost instantaneously. And here is the harsh, unavoidable truth: America imports goods valued at $3.8 trillion annually, which accounts for approximately 15% of its GDP. If these imports suddenly become 40% more expensive due to dollar devaluation, that represents an additional $1.5 trillion in costs that will be directly passed on to American consumers. The average American household currently spends roughly $72,000 per year. However, as oil can increasingly be purchased in yuan, euros, or yen, those countries no longer need to maintain such extensive dollar reserves. China, for example, can now hold yuan reserves, while European nations can hold euro reserves. As they progressively reduce their dollar holdings, those dollars will inevitably flow back into the United States. This phenomenon is known as reverse currency flow, and its direct consequence is inflation. Let's examine the underlying arithmetic. If foreign central banks decide to reduce their dollar holdings by, say, $2 trillion over the next 5 years, that constitutes an additional $2 trillion in dollars that will flow back into the U.S. economy. This influx represents $2 trillion in additional money supply, relentlessly chasing the same finite quantity of American goods and services. According to basic economic principles, more money pursuing the same goods inevitably leads to higher prices. How much higher? If the U.S. money supply increases by $2 trillion, which is roughly a 10% surge, prices across the board will increase by approximately 10%. Your 100-pound grocery bill will become 110 pounds. Your 50-pound tank of petrol will cost 55 pounds. Your 2,000-pound monthly rent will increase to 2,200 pounds. Across the spectrum, everything will cost 10% more. But this is merely the consequence of a $2 trillion inflow. If the full collapse of the petrodollar precipitates the return of $4 trillion to $6 trillion over the coming decade, you are looking at an additional 20% to 30% inflation, compounded on top of whatever existing inflationary pressures already persist. But the situation deteriorates further because the second critical effect will be significant dollar devaluation in global foreign exchange markets. When countries no longer have a pressing need to hold dollars for oil transactions, they will naturally begin to sell their dollar holdings and acquire other currencies. The initial major oil for yuan contracts were swiftly signed in late 2024. China now formally pays for Saudi oil in yuan. These yuan subsequently flow into Saudi Arabia's central bank reserves, and Saudi Arabia then utilizes these yuan to purchase Chinese goods, invest in Chinese infrastructure projects through the ambitious Belt and Road Initiative, or convert them into other currencies as and when required. The US dollar has been entirely excised from this crucial transaction. And this, crucially, is merely the beginning. Russia is currently selling oil to India in rupees and to China in yuan. Venezuela, Iran, and Iraq are all progressively transitioning towards multi-currency oil sales. The petrodollar system is not merely dying a slow death, it is rapidly disintegrating. The verifiable figures unequivocally substantiate this trend. In 2020, approximately 95% of global oil transactions were denominated in US dollars. By late 2024, that figure has precipitously fallen to around 80%. This represents a significant 15 percentage point decline in just 4 years, and the pace of this shift is actively accelerating. Analysts now estimate that by 2027, the dollar share of oil transactions will drop below 70%. By 2030, it could well fall beneath 60%. And here is precisely why this unfolding scenario is utterly catastrophic for America. Let me now elaborate on the specific mechanism through which this shift will systematically erode your purchasing power. This is not an abstract economic theory. This directly impacts your grocery bill, your fuel costs, and your overall cost of living. The petrodollar system artificially sustained a massive demand for the dollar. Nations historically needed to hold approximately $8 trillion in dollar reserves to facilitate global oil trade and other international commerce. That represents $8 trillion in US dollars quiescently sitting in foreign central banks, not actively circulating within the US economy. Instead, the kingdom announced its intention to accept payment for oil in a diverse range of currencies, including US dollars, Chinese yuan, euros, Japanese yen, and even various digital currencies, encompassing potential central bank digital currencies. The official Saudi statement declared this move was intended to strengthen financial cooperation and diversify economic partnerships. However, the underlying message was clear. We no longer require exclusive American protection. We now possess other viable options. Significantly, China has emerged as Saudi Arabia's largest oil customer, and China has consistently expressed its desire to pay in yuan. Saudi Arabia has now acceded to this demand. This pivotal decision did not materialize in a vacuum. It followed a period of several years marked by deteriorating U.S.-Saudi relations. In 2022, for example, President Biden visited Saudi Arabia and publicly urged them to increase oil production to help lower global prices, a request which Saudi Arabia ultimately refused. In 2023, Saudi Arabia, in concert with Russia, both major oil producers, coordinated significant production cuts, deliberately aiming to keep prices high, a move that directly contradicted stated U.S. interests. In early 2024, Saudi Arabia further signaled its shifting alliances by formally joining BRICS, an economic alliance explicitly designed to reduce global dependence on the U.S. dollar. Throughout all these developments, China has been aggressively courting Saudi Arabia, intensifying its economic and diplomatic overtures. In 2023, China purchased an astounding 1.8 million barrels per day from Saudi Arabia, thereby cementing its position as Saudi Arabia's single largest customer, surpassing even the United States. For years, China had been posing a consistent question: why must we pay you in dollars? We are the buyer, you are the seller. We should be able to pay in yuan. And in June 2024, Saudi Arabia finally agreed. However, because the global economy perpetually needed dollars for oil, a significant proportion of these newly printed dollars would flow overseas. They would reside in the reserves of foreign central banks or be held within the sovereign wealth funds of oil-producing nations. Consequently, the inflationary pressures were diffused and exported globally, rather than being concentrated solely within the United States. This represents the most insidious aspect of the petrodollar system. It enabled America to live well beyond its means for 5 decades, effectively making the entire world subsidize its spending through the gradual debasement of the dollar. And crucially, no other nation could effectively challenge this arrangement, precisely because everyone was beholden to the dollar for their oil supplies. This was the ultimate privilege, the ability to print the very currency the world desperately needed. The capacity to incur trillion-dollar deficits without immediate, crippling consequences. The means to finance a vast global military empire, comprising 750 bases spread across 80 countries, without having to levy substantial taxes on American citizens to foot the bill. Instead, the strategy was simple: print dollars, export the inflation, and let the rest of the world bear the financial burden. The petrodollar was, unequivocally, the cornerstone of the American empire. And on June 9, 2024, it reached its denouement. Allow me to detail precisely what transpired. On June 9, 2024, the 50-year petrodollar agreement between the United States and Saudi Arabia officially expired. It's important to note that this wasn't a formal, publicly ratified treaty. Rather, it comprised a series of mutual understandings and agreements that were formalized in the 1970s. However, the 50-year time frame was widely acknowledged and understood within both diplomatic and financial circles. And in June 2024, Saudi Arabia made the decisive choice not to renew it. Japan, for instance, didn't hold dollars out of an intrinsic trust in the U.S. government. It held dollars because they were an absolute necessity for buying oil from Saudi Arabia. This artificial demand exerted 3 monumental effects on American power. Firstly, it ensured the dollar remained robust, irrespective of underlying U.S. economic fundamentals. Even when the U.S. incurred colossal trade deficits, and even when it flooded the market with trillions in newly printed currency, the dollar remarkably maintained its strength because the world's insatiable need for dollars to purchase oil guaranteed constant demand. Secondly, it allowed the U.S. government to borrow money at artificially depressed interest rates. Countries that accrued dollars, whether from selling goods to America or from selling their own oil, would then take those dollars and invest them by purchasing U.S. Treasury bonds. Why? Because they required a secure and liquid repository for their dollar holdings until such time as they needed to be deployed for oil purchases. This advantageous situation meant that the U.S. government could borrow trillions of dollars at remarkably low interest rates, often just 2%, 3%, or 4%. Even while simultaneously running enormous deficits. Any other nation attempting such fiscal behavior would invariably witness their interest rates spike dramatically, perhaps to 10%, 15%, or even 20%. But not America, thanks entirely to the unique leverage afforded by the petrodollar. Thirdly, and perhaps most crucially, it bestowed upon the U.S. the unparalleled capacity to print money and effectively export the ensuing inflation. When the U.S. Federal Reserve decided to print $1 trillion in a normal economic scenario, this influx of money should trigger substantial domestic inflation within America, creating a situation of too much money chasing too few goods and causing prices to skyrocket. Why would anyone place their trust in mere paper that a government could seemingly print without limit? But then, in 1973, the United States orchestrated a brilliant deal that not only salvaged the dollar, but also forged the most potent economic weapon in modern history. Following the 1973 Arab oil embargo, a period when OPEC ceased selling oil to countries supporting Israel, leading to petrol prices quadrupling and lengthy queues forming at fuel stations across America, the U.S. dispatched Secretary of State Henry Kissinger to Saudi Arabia with a compelling proposition. The core elements of the deal were remarkably simple, yet strategically brilliant. Saudi Arabia would commit to selling all its oil exclusively in U.S. dollars. No other currency would be accepted. In return, the United States would provide Saudi Arabia with comprehensive military protection, an assured supply of advanced weaponry, and robust security guarantees designed to perpetually maintain its royal family in power. Saudi Arabia readily agreed to these terms. And because Saudi Arabia held the undisputed position as the world's largest oil producer and the de facto leader of OPEC, other oil-producing nations had little choice but to follow suit. By 1975, all OPEC oil was uniformly priced and traded exclusively in U.S. dollars. Thus, the petrodollar system was firmly established. Herein lay the immense power of this system. Oil is unquestionably the most heavily traded commodity on Earth. Every nation depends on it. Japan requires oil, Germany needs oil, China demands oil, India consumes oil. And if oil could only be acquired with dollars, then every single country, without exception, needed to possess dollars, not primarily to engage in trade with America, but specifically to purchase oil. This fundamental requirement generated what is aptly termed artificial demand for the dollar. Europe lay in ruins, and Asia was similarly devastated. Consequently, the U.S. stood as the only nation capable of manufacturing goods on a substantial scale. It was at the historic Bretton Woods Conference that the world collectively agreed to designate the U.S. dollar as the preeminent global reserve currency. Every other currency would be inextricably linked to the dollar, and crucially, the dollar itself would be backed by gold at a fixed rate of $35 per ounce. This arrangement conferred immense legitimacy upon the dollar. It was not merely paper, but genuinely as good as gold. However, a fundamental problem began to manifest by the late 1960s. The United States found itself spending considerably more than it was earning. The escalating Vietnam War was draining billions from the national coffers, while the ambitious Great Society domestic programs were similarly costing billions. Foreign governments, particularly France under the assertive leadership of Charles de Gaulle, grew increasingly concerned and began to demand gold in exchange for their dollar holdings. By 1971, America's gold reserves were depleting at an alarming rate. If this trend had continued unchecked, the United States faced the very real prospect of running out of gold entirely. Therefore, on August 15, 1971, President Nixon appeared on national television to make a momentous announcement. The United States would temporarily close the gold window. This meant no more gold could be exchanged for dollars. The dollar was thereby transformed into a pure fiat currency, its value now backed by nothing more than the prevailing trust in the U.S. government. That pivotal decision was made 54 years ago, and the gold window, of course, never reopened. Logically, this radical shift should have utterly destroyed the dollar's credibility. Why, after all, would any entity continue to hold a currency that was no longer backed by anything tangible? And when the dollar loses between 40% and 60% of its value, a trajectory consistent with every currency in history that has forfeited its reserve status, every single item you import will become 40% to 60% more expensive overnight. This includes petrol at the pump, imported foodstuffs, electronics, clothing, essential medicines, and virtually everything else. Your cost of living will skyrocket while your income stagnates. This is not a gradual decline. It is a sudden plummet, and we effectively drove off that cliff in June 2024. Over the next few minutes, I will meticulously detail the intricate workings of the petrodollar system and explain precisely why it granted America unparalleled power for 50 years. I will illuminate what transpired on June 9, 2024, and why it represents an irreversible turning point. Furthermore, I will demonstrate how the collapse of the petrodollar will decimate your purchasing power through a mechanism that most individuals fail to grasp. We'll examine the projected timeline for dollar devaluation based on historical precedents. And most crucially, I will outline the immediate steps you must take to safeguard yourself before petrol prices soar to $10 to $15 per gallon and your weekly grocery bill doubles. This is imperative because the petrodollar was far more than just about oil. It was the ingenious mechanism that enabled America to print unlimited money, accrue limitless deficits, finance countless wars, and sustain a global empire without having to genuinely pay its own way. And that mechanism has now irrevocably broken. Allow me to commence by illustrating the actual mechanics of the petrodollar system. A thorough understanding of this underlying mechanism is the sole means by which one can comprehend why its impending collapse is nothing short of catastrophic. In 1944, as the Second World War drew to a close, the United States emerged as the singular major industrial power with its extensive infrastructure largely unscathed. A seismic event occurred on June 9, 2024, an event poised to dismantle the American economy, erode the dollar's global preeminence, and precipitously reduce your standard of living by a staggering 40% within the next 5 years. Yet, the American media, seemingly oblivious or deliberately downplaying its significance, relegated this monumental news to page 17. On that fateful day, Saudi Arabia quietly permitted its 50-year petrodollar agreement with the United States to reach its expiration without renewal. For half a century, since 1974, Saudi Arabia had maintained an ironclad arrangement with America. They would exclusively sell their oil in US dollars. This singular agreement compelled every nation on earth requiring oil, which, effectively, meant every country, to hold dollars, to acquire dollars, and to maintain dollar reserves. It artificially inflated demand for the dollar, a demand entirely disconnected from the underlying strength of the U.S. economy and solely attributable to the fact that crude oil simply couldn't be purchased without it. However, on June 9, 2024, that pivotal agreement officially concluded. Saudi Arabia subsequently announced its readiness to accept payment for oil in a diverse array of currencies, including the Chinese yuan, euros, Japanese yen, and even various digital currencies. No longer exclusively dollars. Now, any currency would be considered. The petrodollar system, which had served as the bedrock of American financial dominance for an impressive 5 decades, effectively ceased to exist. And alarmingly, most Americans remain utterly unaware of the profound implications this holds for their future. So what exactly does this mean? When nations no longer require dollars to procure oil, they will progressively cease to maintain vast dollar reserves. As they divest from holding these dollars, the global demand for the US dollar will inevitably collapse. A collapse in demand invariably leads to a collapse in value. Aim to allocate 10% to 20% of your liquid net worth into physical gold and silver. Own assets that produce essential goods. Consider farmland, productive real estate, or businesses that provide fundamental necessities. When the dollar collapses, a farm will still yield food. An apartment building will continue to offer shelter. These types of assets retain their inherent value, independent of the prevailing currency. Reduce dollar-denominated debt, particularly if it is variable rate. Credit cards, home equity lines of credit, HELOCs, and variable business loans. Pay these off now. When interest rates surge to 8% to 10%, variable debt will swiftly decimate your financial stability. Conversely, maintain fixed-rate debt, such as a 30-year mortgage at 3%, as inflation will ironically assist you by devaluing the real cost of such fixed obligations. Diversify into robust foreign currencies. If feasible, hold Swiss francs, Singapore dollars, or Norwegian kroner. When the dollar depreciates by 40%, these currencies will appreciate by a corresponding 40% relative to the dollar, thereby safeguarding your purchasing power. Own stocks of companies with substantial international revenue and tangible hard assets. Focus on energy companies, mining companies, agricultural corporations, and other businesses that produce essential commodities the world will always require, regardless of which currency dominates global trade. Critically, avoid U.S. domestic consumer companies, as American consumer spending will inevitably collapse as citizens become poorer. Cultivate and build skills that provide demonstrable value in any currency system. This includes medical skills, engineering expertise, or skilled trades. When currencies collapse and economic systems falter, the individuals who not only survive but thrive are those who can provide tangible, indispensable value through their abilities.